Alan Greenspan yesterday suggesting growth has peaked. Today, stocks are rebounding from their worst day in 2 weeks, a day after Chairman Powell raised interest rates, setting the stage for 2 more hikes this year. Mario Draghi of the European Central Bank this morning announcing its plan to end bond buying at the end of the year. Joining us now is our own Bob Pisani and our own Steve Liesman. A lot to chew on, guys. Steve, if you had to wrap it all up into one theme, feels like the easy money days of post-financial crisis are ending.
Yeah, gradually coming to an end in a very telegraphed way, in a way that doesn't seem to be really upsetting markets too much. They seem to be telling you what they're going to do, and then telling you what they're doing, and then explaining why they did it. So it seems to be going down reasonably well. That extra rate hike this year seems to be being digested by the markets, and there isn't a sense that the overall idea that rates are going to remain low and remain low relative to growth that's pretty strong, at least for now. That seems to be intact. And the ECB, of course, acted this morning. A little bit of a tumult in the euro, which weakened quite a bit, fell out of bed, and then kind of fell out of bed again if you look at the chart. But again, markets seem to be digesting it pretty well, and you can kind of expect that the ECB is going to have this long trajectory of reducing accommodation. So nobody's panicking, I think, here, Sarah.
Yeah, that euro intraday chart is certainly the chart of the day. You don't see a 1.3% currency move every day, Bob. How is it impacting stocks?
Well, no rate hike in Europe. That's what moves things, and that's what's important. You know, it's interesting. We seem to be having this moment of obsession with peaks. Remember, we were 2 months ago, everybody was obsessed with peak earnings. This is it, folks. Peak earnings, it's going to happen, except it didn't. And now we're sort of obsessed with peak GDP, as Mr. Greenspan seemed to imply there. So everybody's trying to figure out where the top is. It hasn't happened with the stock market, though. Remember, everybody was obsessed with that peak earnings, and then Q1 numbers came out, and the Q2 guidance, everybody said, oh, heavens, they're bringing the numbers up for Q2, Q3, and Q4. And Q3 numbers now are likely going to be higher than Q1. We are not at peak earnings, so that theory wasn't quite right. So I think the stock market has accurately figured out that we've got a ways to go. It may be that 2019 numbers aren't going to be as high because of the tax cut, and the effect is now priced in, but we're still got a long ways to go in terms of any kind of negative movement in growth and earnings.
Yeah, but Steve, almost implicit in the fact that the markets are okay with this is the idea that the ECB's actions, QE and all the rest of it, were not necessarily instrumental to the growth outlook over there. I mean, it seems as if people were wondering if, in fact, you're going to have any kind of a growth penalty even next summer when rates might go up in Europe.
Well, I think the idea, Mike, as it is in the United States, is that we can do this essentially a handoff. It's a relay race where for a while it was the monetary policy instruments that were running and pushing growth, and now they're handing it off, at least in the United States, to the fiscal side, and in Europe, I think, more to the private sector here. Look, Bob kind of raised the big issue that's out there, which is more a question of not in the United States if there's weaker growth, but what if there's stronger growth? It's very interesting to look at the trajectory of Fed growth rates, and what you find is that they don't see these good times lasting, and not a single member does, really. They got 2.8 for 2018. They go down to 2.4, and then they go back to a trend of 2%. So they're not necessarily buying this idea, which is in the Office of Management and Budget, the White House's forecast of kind of 3% into perpetuity.
It's a little noisy down here on the floor, but Steve raises a good point, which is a lot of economists, Alan Greenspan, you heard it, and others do say this might be as good as it gets. And we do have a front-loaded fiscal policy, which is the tax cuts, the deregulation, which is certainly helping now, but it can't last forever.
Yes, and of course I would reference the spectacularly accurate Fed forecasting history that exists out there. So the important thing is I watch what the companies say. What I hear in second, third, and fourth quarter is their businesses are generally doing terrifically. Even now, look at when things slow down. We had energy stocks move up a little while ago, and they moved up and helped the market. Now they're sort of sideways. We had banks move up. Now they're sort of sideways. We had consumer discretionary stocks. Now they're leading because the retailers are doing so well. Media stocks are also doing well. That's in that group. And of course, you've got Amazon and Netflix helping out. So we get this rotation in the market because certain sectors sort of come in, do well for a short period, then move sideways, and then you get other sectors coming in. That's a real sign of growth. It's not a tech. It's true that techs are the biggest leaders, but they're not the only leaders that are out there.
Bob, let me give you some back of the envelope here, which is that And I don't, you can't put this stuff in stone. But okay, let's say you're right that the Fed is wrong, and I think there's a good chance they are here. Let's say growth does upshift or shift up by a percentage point. I don't think it's crazy to think about the Fed shifting up its interest rate forecast by a percentage point. The idea being as potential growth would increase, so would the long-run funds rate. So the long-run funds rate is now seen at 2.9%, and the Fed's seen going a bit above that in 2019, 2020. But what if that funds rate is 4% and the Fed has to go up above that? I know that's a stretch. It's hard to imagine, but you can't have it both ways. You can't posit this idea that the Fed is low and wrong on growth and it's going to stick to the same neutral rate for the funds rate.
No, they'll definitely go out and change their forecast, and how well they manage that forecast is going to determine how stocks react. Obviously, if suddenly they get a lot more aggressive, the market's going to move. Let's look what happened today.
Home builders. I thought you were going to say home builders yesterday.
Yeah, home builders were down. There was an independent analyst report that was out yesterday. It was a bit critical of where the markets were in May. That wasn't quite as strong for them. So I think that was an influence there. But, you know, look, the facts change. The Fed's going to change a little bit. And I think the Fed has done a great job managing expectations, and that's what the market wants. They want to manage expectations. I think it can handle higher interest rates with the economy stronger, but again, how the Fed goes about doing that is going to be very important.
And how long it lasts, Bob. I will just leave you with, I know you're listening to company commentary. I'm watching the yield curve. I mean, the yield curve continues to narrow, and if it does invert, I think there will be a lot of questions about short-term good, but pretty soon recession around the corner.
That's certainly the long-term historical pattern. But again, there are even people who say inverted yield curves aren't what they used to be. Given the demand out there for long-term paper, it's particularly in Europe, coming in and buying and keeping those yields down on a relative basis.
It's a good debate, guys, and one we will continue to have here. Steve Liesman, thank you. Bob Pisani, thanks to you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.